All right, good afternoon. And today, as the topic rightly said, we are going to be talking about trade management, and then we are going to be looking at different reasons as to the different aspects that we can have to trade management. So first off, as an introduction, when we talk about trade management, what are we talking about? So trade management basically it's just like the way it sounds, or just like what it sounds, and that's what it implies. Managing your trade. All right, managing your trade. So trade management deals with managing your trade. It deals with managing your trade. And then you have to understand that, for example, now if you look at reasons why traders lose some of their trades, all right, most traders, a good number of traders don't lose their trade because of the bad entries. Rather they lose their trades, because they don't know how to manage their trade. So a good number of traders lose their trade because they don't know how to manage their trade. I remember that as when I started trading as a much earlier when I started trading, there are times that I'm already on profit, and then and I see that a lot with a number of people around me that were trading too, and they're still trading now. That you are in profit already, and then the profit runs back into a loss. I remember that then it was one of the things that I was always quick to tell students and people that I was teaching that were learning from me, that never let a winning trade, don't never close a winning trade in loss. Never close a winning trade in loss. So if a trade is already winning, the worst you should get out, on that trade with is break even. Is break even. You cannot afford to close a winning trade in loss. So just like I said earlier, that most traders don't lose money in the market because of bad entries. Rather, they lose money in the market because of bad trade management. And that's what we're going to be looking at today, the different aspects. What exactly is trade management? When we are talking about trade management, what exactly are we talking about? Okay, what exactly are we talking about? So when we talk about trade management, what exactly are we talking about? Well, trade management is basically what you do after entering a trade. You putting it, in a very simple way. That is what trade management is. What you do after entering a trade. It is not what you do when you are analyzing. That's not trade management. It is not what you do before before you enter a trade. Rather, for example, okay, what if I'm trading, pending others? If I'm trading with pending others, what is trade management? So if I'm trading with pending others, trade management is what I do after that order is activated. All right. If I've set a pending order, after that order is live, after it is live in the market, after it goes live in the market, trade management is what I do after. I believe we all get that. Trade management is what I do after. Trade management is what I do after. So trade management is what I do after the market is live. Trade management is what I do, after entering a trade. Now, trade management can basically be divided into four different things, and I want you to pay good attention. Trade management can be divided into four different aspects, as it were. So the first one, you have your stop loss. Those are one of the actions you do when a trade is already going on. Your stop loss. Then you have your take profit for the second one. So I say the first one is your stop loss, the second is your take profit. All right. Now, the third aspect of trade management is risk control. Now, this has to do with your stop loss, and we're going to get there in a while. So, the third part is your risk control, while the fourth part is your trade all right, is your exit decisions, your trade exit decisions. I go again with the four. So the first one is your stop loss, the second one is your take profit, the third one, all right, is your risk control. This has to do with your stop loss as well, your risk control, while the fourth one is your trade exit decisions. And this is something that is very important. A number of traders know when to enter the market, but they know how to enter the market, they don't know how to get out of the market. And you see, getting out of the market is as important. So getting out of the market, so getting out of the market is as important as getting in the market. So, because we have to understand that getting out of the market is as important as getting in the market. Because sometimes, you are in the market now, your trade is going on, you are making profits. All right. You have to know there is and it's not just something that is, that is controlled by emotions. No, trade management is not something that you do by emotions. Rather, it is something that you do, all right? It is something that you do by structure. I'm going to explain this much later rather. It is something that you do by structure, all right? So your trade management, the four things aspect of trade management, as I said earlier, I will just go over that again. Your stop loss, your take profit, all right. Then the third one, your risk control, which has to do with your stop loss, your risk control, and then your trade exit strategy. Most of us, a good number of traders have. This is what you look at to enter the market. You look at clinical, SMC, smart money concepts. You look at order block. You look at your support and resistance. You look at your highs and lows, as I have taught you in the class. But then, what exactly do I look at to get out of the market? Most traders don't know. And because if you don't know how to get out rightly, what it means is that you are at a risk of getting out wrongly. If you don't know how to get out rightly, you are at a risk of getting out wrongly. So first off, we're going to take a look at stop loss. We're going to take a look at stop loss, and we're going to take a look at stop loss. And number one, the first thing you should notice about your stop loss is that your stop loss is the non-negotiable. You cannot, you should not, you must not, be live in the market without setting your stop loss. You should never do that. All right. You should never do that. You should never do that. So you should never be live in the market without setting your stop loss. All right. Now, a little bit of experience that I want to share in that. I think this was sometime in 2020 during that COVID-19 lockdown and all that. So I remember that I was trading, and then there was a friend like that, a friend of mine like that was in South Africa, South African trader. So he was handling one of my accounts, and got so good. The first month he handled it pretty well, and then I think we had about 200% returns on that account, on that account in the first month. Now, so the second month, but then I noticed that this guy does not set stop loss. Now, I was not the one. I didn't quickly notice. All right, it was like a whole business plan. I wasn't the only one who was managing his account. He was managing accounts for a number of other people, and while I was helping him just manage those accounts too, he's the one trading on those accounts. I'm just helping him manage the account. And I noticed that this guy does not set stop loss on his trades. Now, guys, you wouldn't believe it. That was his undoing. That was what led, to a lot of accounts getting blown. A lot of accounts, were like wiped out. Why? There was no stop loss. And that was why I said that the third point is about risk control has to do a lot with stop loss. So if you don't set stop loss, what it means is that you are risking everything in your account. That is what it means. So stop loss is very, very important, all right, in a trade that is live. Stop loss is very important. That is how you cut your losses. All right, so stop loss is a non-negotiable. Stop loss is a non-negotiable. Now, stop loss, should it be based on emotions or on structure? Stop loss should be based on structure, not on emotions. It means that there are things in the market that determines how stop loss should be based. Now, I'm going to share my screen now, and then to show you, we look at a live example, and we'll see how we can go with that. All right. Okay, I think you can see my screen now. I think you can see my screen now. All right. So if you can see my screen clearly, you would see that this is XAU USD. This is gold chart, and I'm just going to be using this as an example. All right. And now note the blue line here, this blue line, and I wrote. You can see I wrote entry. So let's assume you enter a trade for buy here. Look at the black long arrow. You are predicting that the market moves up. All right, that the market is bullish. Okay, that is what you are predicting. Now, if this is your entry, that means that you are in profit already. You can see that you are in profit already. So if I take this is 1 hour chart, let's take this to 15 minutes. The chart is loading. Okay, I don't know why it is slow here. Let's check 15 minutes again. I think it's coming up now. Okay, I'm just going to stick to 1 hour because of the chart, of how the chart is doing. All right, so on 1 hour now, you can see your entry. Now, so the chart comes up, it makes a high here, comes back down to make a low, goes back up, makes an higher high, comes back, makes a higher low, goes back, make another higher high, comes back here and higher low, makes another higher high here. Now, you can note that the market is moving in your favor. The market is moving in your favor. It is moving in a in a mini like a mini uptrend here now. Now you can see that now clearly. Now, if you want to set your stop loss for this kind of chart now, this is the low. You come to the low of this, the lowest, the low of this particular of your entry, and a little you give it a little bit of gap, a little bit of pips, below that. All right, and you can set your stop loss there. All right, you can set your stop loss there. Now, you can set your stop loss there. Let me try to see if you can set your stop loss there. So your SL. All right. Now, if you set your stop loss there, now the market is going in your direction, is moving in your direction. Now, don't forget, a market is said to be in an uptrend. I told you that earlier, that when it keeps forming higher high and higher lows, right? And it works across all time frames. When the market keeps forming higher high and higher lows, the market is in an uptrend. And when it starts forming lower highs and lower lows, the market is in a downtrend. So when this particular kind of trade now, when is this trade invalid? How do you get out of this particular kind of trade? Well, the number one way you get out of this particular kind of trade is that you notice the closest support, and resistance. Now, don't forget where this SL is. We can call it, it is a support, right? The price is bouncing off it. Now, if you want to draw a resistance line here, and I already, and as I taught you already, that the support and resistance are not lines, they are zoom. Okay, I'm not sure you can see this color, so I'm going to change the color so you see it well. Where is that? Okay, I think you can see that now. So you can see that this red long triangle. So that's like my support and resistance. Don't forget, I told you earlier that it is not a line, it is a zone. So this is a similar kind of zone for support and resistance. So it means that you can put you can set your take profit now. You can set your take profit somewhere, maybe to be, if you want to like be a conservative trader and you want to trade safely, you can set your TP, all right, you can set your TP somewhere just beneath the just beneath this place, all right. Now, but you will notice that in this particular trade, price did not touch that TP, it did not hit. So if it did not hit, it means that so it keeps going, but you see that price keeps forming higher and higher low up to this place where you can see the mouse. So the price comes back here and it fails to form a higher high with respect to this high. Where let me put the black arrow there. With respect to this high, now this shows you already that that mini uptrend is already getting invalidated. That is, that is already weakening. So this place is a good place to take your profit. You can get out of the market from this place. All right, I believe we all get that example. Just for that proof what I was saying earlier, that that in the market you must know how to enter and you must know how to enter and how to exit the market. You must know how to enter and how to exit the financial market. Okay, now this is gold, and gold is presently live. Gold is presently live. Now I'm drawing this channel so you can see. So you can see the trend line here. So you can see the trend line that I drew down here. Now, if market is selling, we are waiting for. All right. So let's assume you do this trend line from here. Price went up, came back down. Now there's that trend line there. Then there is a support and resistance level here, right? If you remember what you were taught. So the support and resistance level here is zone rather, Abina. So don't forget what we saw, that price respect, and that is what technical analysis is. Price respect the zone. So this is what we are going to imagine. Imagine that, let's say, off the back of, you can draw another similarly support and resistance here. Somewhere down here. So let's say with respect to this, you are entering the market from here. And let's say from this place now, let me write something there so you see it. So let's say you enter the market from here. This is your entry. If you can see it. Now, if this is your entry, now market keeps going. Now, one of the ways to set your stop loss now is that if this is your entry, don't forget you set your stop loss few pips behind the low, few pips behind, the particular true on that chart. So few pips behind the low. So your stop loss, few pips behind the low. So that is your stop loss. Now, your take profits, you can easily use the next resistance level as your take profit. All right, you can use, because if market came down like this and this is where you are entering your buy, your buy, you have to also note that there are many, all right, resistance levels somewhere like this place now. Might not be much, but you can see the mini resistance level here. All right, might not be much, but you can see it there. You get? So you can either use that. For example, there's another one here. Let's just duplicate this. Let's clone this. So there's another one here, and you will notice that price respected it almost immediately it got there. So if you are entering from here, price respected this part. So your stock, your take profits can, you can have like you can have like different take profit for this trade, as I'm still going to explain earlier. I said earlier rather, pardon me, as I'm still going to explain later. So this can be one TP. Then let's clone this. So this can be another TP. All right. If you are cloning this, then this can be your TP3. Okay. So you have your TP1, and I'm going to explain what that, how you can use that very soon. You have your TP1, your TP2, and your TP3. Now, so if this is your entry, now this is a very good trade, all right? If you are entering from here, this is good. Now, this market, now this market is live, for example. Now, so this is good now. Now, so if you let's assume you entered here, you entered from this place, and then the market keeps moving. So you can, if you entered from this where the mouse is now, and that's your entry, and the market keeps moving, you can either get out of the market at TP1, you can set your TP there. You can get out of the market at TP2, you can set your TP there. You can get out of the market at TP3, you can set your TP there. Now, what this simply means is that what this simply means is that when you are talking, I'm already talking about take profits now. You will notice I'm no longer talking about stop loss. So you don't get out of the market, and I'm doing all this analysis and explanation just so you can know that you don't get out of the market just based on your emotions. You get out of the market because based on structure, based on what you are seeing in the market. You get out of the market based on structure, based on what you are seeing in the market. That is the justification to get out of the market. So there is a way to set your stop loss. There is a way to set your take profit. So if you enter the market here now, all right, you can see that, okay, based on this former support and this former resistance, where you can see that zone, that is your TP1. Then if you, or you can, okay, that's your TP1. Okay, if market now crosses this, I can also get out at TP2, and I can also get out at TP3. All right, and I also get out at TP3. Now, when you talk about take profits particularly, you have basically two kinds of take profits. You have your fixed take profits, your fixed TP, and you also have your dynamic TP. Now, fixed TP is where you set your take profits there. That is it. You are not moving it. Whenever price gets there, you want the market to stop you out. Okay. Now, there is dynamic TP in that you are the TP is open for movement. For example, let's say you are in this trade now, and your initial TP that you set, you put it at TP1. Now, if you put it at TP1, what that means is that, let's say as the market now keeps progressing, you now say that there's a chance that this market is going to go more than TP1. So what do you do now? You now move the trade. So you move your TP to TP2. You can also still move your TP to TP3. Do you understand what I'm trying to say? For example, now, if you look at it critically, there is another is, and you can leave it like that. So now, but then, is there a possibility? Can you see that now? You can see the chart on a bigger level now. So there's a possibility, if there's a possibility that price breaks through this particular zone, this TP3 zone, if there's possibility that if price breaks through this TP3 zone, the next zone that we are looking at, okay, I think there's a smaller one. There's a similarly smaller zone here, and I'm just going to highlight it out. All right, there's a smaller zone here, isn't it? If you pay attention closely. So it means that the next zone that we are looking at, if price breaks through this TP3 zone, all right, is this one right above it, and then the one right above it. So you can see that price can move in different zones like that. So, and that is how price moves generally. You have to understand that. So it means that you don't make, and because you have to understand that in trade management, you don't make money in the market by price movement. You make money from the market when you close. So if a price is moving in your direction, but you are yet to close that trade, it means that the price can still go back to move against you. All right. So it means that you make money from the market when you close the trade. And that is why knowing when to close is important in the market. For example, now, if you are buying this market from here, if you are buying this market, you are bullish on this part on gold presently, and you've been in the market at from entry, you are still in market. You don't have to close, because if you look at it, the market is still in an uptrend. It is still forming higher highs and higher lows. However, you are now going to keep your eyes peeled that this present place where the price is, you are expecting the price to go higher, to break through this TP3 zone. If if price now breaks through this TP3 zone, you know that you are still in market. But if price now pushes back down and is unable to break through this particular zone, what it means is that the setup is weakening, and now you want to keep your eyes peeled that, okay, maybe I can go out of this market from here, take my profit from here or not. I believe we all understand that. I believe that is very straightforward. All right, I believe that is very straightforward. So let's move on from there. Move on from there. Let's consider now, just as I was saying, now we are now going to consider moving your stop loss to break even and trailing your stop loss. What does it mean? Now let's go back to our chart. Moving stop loss to break even and trailing your stop loss. Now let's go back to our chart. Now on this trade, now, don't forget, we saw that, wow, gold is moving. Fantabulous. Fantabulous. Gold is moving. If you are in this trade now, you are making money. All right, as you can see, it was not a trade that I was in. But then, as just we saw from the analysis now, that it's a good way, it's a good trade. It looks like a good trade. Now, back to what we are saying. Now, don't forget, this is where your stop, this blue line down here is the typification of your stop loss. Now, if the trade has moved in your favor, what do? You move your stop loss. Now let me shift the chart up so you can see the chart clearly. You move your stop loss to your entry. Can you see? So when you move your stop loss to your entry, what you have done is that, number one, you are not risking any amount of money on that trade again. The risk for that trade is now $0. All right. So then you have, and that is what it means to break even, in the sense that I have moved my stop loss to break even. That is, I am not risking anything for that trade. So even if the trade goes against me, I am in profit. All right, I am in profit. Now, if you now want to, now let's talk about trailing your stop loss. If you are trailing your stop loss, what it means is that from the word trail, you are trailing someone, or you are trailing someone. That means as the person is going, you are following the person. All right, not too closely now, okay, not too closely, but not too far apart too. So and when we say we are trailing stop loss, it means that we are using the stop loss to trade something. What are we trading? We are trading price. So we are using the stop loss to trail price. We are using the stop loss to trade price. Now, what do I mean by that? Now, so from the entry, now in this particular trade, now we can confidently move the stop loss to this low here. This is the previous, let me see that well. Okay, yeah. This is the previous low in the market. So if once we do this, now what this means is that from our point of entry to this place where you have the blue line, we have locked that profit. Okay, we have locked that profit. Okay, you see that? So I want to show you that. So from our point of entry to the place where we have the blue line, that is where our stop loss is presently. We have locked that profit. Now, and the reason for that is because we are giving this market room to run. Some people can even go ahead and say they want to place their stop loss here under this let me correct that. So under this particular low, all right, under this particular low, so such that if the market, but the only disadvantage of that is that if the market comes against them now, all right, and it is okay, and I think it's very okay, you can set your stop loss here. You can absolutely set your stop loss here, because don't forget, if the market is going to stay in an uptrend, the market should keep forming higher highs and higher lows. So it means that you are not expecting the next low that this market will form to be here. But the reason why I'm not going to advise you to put your stop loss here is because the market is yet to form an higher high. If the market forms another high that exits, that breaks through this TP3 zone, all right, once the market does that, you can put your stop loss here. But the market has not done that. Let me just delete this one. Where we drew it earlier is advisable. So you give the market room to run. And don't forget, you've already locked all these profits. So if the market comes back down and it decides to start moving in the opposite direction, you are not going to lose money. Rather, you are going to gain this amount of profit that you have locked in the market already. All right, so I believe that is you understand what setting your stop loss according to structure means now, and also what how to trade your stop loss. You understand now how to trade your stop loss. So moving on, I'm just going to be talking about, I'm just going to leave this on the chart and seeing what gold is doing in real time. You can see that it's looking like this particular level is resistance is rejecting the price. You can see that price got there and it started coming back. But then let's see what will be the end product of this, at least for the duration while the class is on. So I'll just leave it on the chart like that. Now, as we rounded up this class, I would like to talk about psychology now. And then psychology is very important in trade management. Psychology is very important in trade management. And why is psychology important in trade management? It is because imagine, look at this trade now. From the entry position, now, for somebody that maybe this intended stop loss zone is the TP1 zone. Now, if the intended stop loss zone is the TP1 zone, what that means is that when the market started pulling back, and don't forget, we saw that the difference between a retracement and a reversal, that a retracement is not necessarily a invalidation of the trend. Rather, if the trend, that retracement is just a pullback, the impulse move is still going to continue as it did towards TP2, towards the zone of TP2. So back to that, if somebody now is on TP1, the market is already buying you, is in my favor, you just see small profit, a little bit of profit, and then the person closed the market. Now, such person has closed the market too early, and that is fear, out of fear that what if the market goes against me, what this small profit that I've seen, let me just close it. No, 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 no. But don't be like that. Do not be like that. Do not be like that. Don't close the market. So you have to master fear. You have to master fear. You have to master fear in your psychology. You have to master fear. Now, the second point to note is greed. You have to master greed also, where you are taking a trade too long. You are holding a trade too long. You are hoping, and you have to understand that in the forex market, hope is not a strategy. You do what the market is telling you. You focus on structure. Hope is not a strategy. I repeat, hope is not a strategy. Rather, you do what the market is telling you. You focus on the structure of your chart. You focus on the structure, of price movement. Hope is not a strategy. You have to understand that, see, most traders don't break rules because they don't know them. No, rather, most traders break rules because of emotions. Most traders don't break rules because they don't know those rules. Rather, they break those rules because of their emotions, because of their emotions. All right. And lastly, as I round up on the class, you have to understand that one of your important, and this is why risk control is very important in the market. You have to protect your capital. You live to fight again another day. You live to fight again another day. So, but then if you lose all your capital, how will you be able to fight again another day? So you have to what? You have to protect your capital. You have to protect your capital. That is how to trade properly. You have to protect your capital. It means that, for example, it is not all trades that are for you. There could be some trades now that the stop loss margin is too big. all right, and you look at, so your stop loss is both the amount you are willing to risk and structure. You have to look at everything together. So if your stop loss, look at this particular chart, this particular goal. Now anybody that is entering this trade now, look at how small the stop loss is, very small. Look at the risk to reward. The risk to reward is almost, if you look at it well, this risk to reward, let's see, let me try to see if I can simplify that. All right. So if you are entering from here, and this is your take profit, let's adjust. My goodness, can you see that the risk to reward is almost 1:6.5? Look at that. For every $1 you risk, you stand a chance of gaining $6.5. Look at that. Look at this particular kind of risk to reward. Very sweet stuff. I like to say it that way. Very, very. I mean, is it not? Can't you see it? Is it not sweet? Very sweet risk to reward. All right. So look at this particular risk to reward now. Very interesting stuff. So yeah, but then there could be some kind of risk to reward that is not, that the what you are risking is too much. Depending on your account size. If your account size can bear that risk, you can go. But if your account size cannot bear that risk, you leave. You leave the trade, you don't trade it. All right. So you have to understand that before you enter a trade, you must be able to typify, to know, you must be able to have found out, all right, where you intend to set your stop loss, and where, your potential TP zones, and then how you intend to manage that trade. Please. So it is very important that you follow structure, not your feeling. In your management, on your trade management, it is very important that you follow structure and not your feeling. Don't forget what I said, that when price moves, that is not what guarantees that you are in profit. It is when you close a trade that you are in profit. It's when you close a trade that you are in profit. It's when you close a trade that you are in profit. I think that will be all for now about trade management. If you have any questions, you can ask me, all right, on our group, and then I will do well to, to answer that accordingly. Thank you very much.